Hello traders, today is the 10th of July 2013 and the time in London is 17:30. The title of this video is Wave Trading Part 10. If you have not watched Part 1 to Part 9, you may do so before watching this. Let's get started. In this Part 10, we will discuss how to use cycle points to achieve a better wave analysis. This video is about wave education, okay, a free wave education for traders that are willing to learn to master Elliott wave theory. All right. What is a cycle point? You can see here I draw some vertical line here. I don't want to go deeply into the cycle point because okay, let's move on very fast. Okay, so we can see here I draw some vertical line here. This is a cycle point here for this stock IBM, the vertical line here. The cycle point, there are different types of cycle point. That's why I don't want to go deeply into it. But what I want traders to remember, we can look at the market itself, which is the S&P 500. Okay, so let's bring on the S&P 500. Okay, and I will show you, okay, the cycle point on the S&P 500. The cycle point usually will take place at a specific time, okay, when a special event did take place, okay. So, for instance, in 2000, where I put this line here, I will remove this one here. The green line, pay attention to the green line, 2000, that's why we have the tech bubbles, when many tech companies were rising, okay, the price was going up, but that bullish trend was not supported by fundamentals. Finally, the bubble has burst. So, at this point in time, talking about cycle point, something, a special event did take place, a major, okay, reversals, okay, occurs. So it's a cycle point, something very, very, okay, a high impact event did take place in 2000. This is a tech bubble. This is a cycle point. In 2003, we had what we call the commodity super cycle. Some traders still believe that commodity super cycle is still underway. But in 2003, most of the gold, okay, producers, okay, commodity, copper, silver, they were starting a new bullish cycle. That's the commodity super cycle that has begun in 2003. Here in 2008, I'm going to move my pink vertical line now. We can see here. 2008, this is about the real estate bubble when a lot of properties, the price of houses was going up, especially in London. You see some houses that are supposed to be £100,000 were valued at £200,000. Same thing in the United States, and in a different part of the world, we see what we call the real estate bubbles. Also, we have the financial crisis, which is the result of the real estate bubble, because the banks were lending money to people who cannot afford to pay back those okay, mortgages. And also, because the bank has on their balance sheet, okay, those houses, so a house that the bank got on the balance sheet supposed to be £200,000 was in fact £100,000. So it's a bad accounting, so to speak, which the bank must now rectify. So it was also creating what we call a financial crisis. This is about 2008. You may say to me, George, I want to stop watching this video now. If you want to learn to master Elliott wave, you must know the cycle points. Very often, sometimes a wave count can become very challenging if you do not know, okay, the cycle point, or you may end up making a wrong decision, wrong trading decisions if you do not know the cycle point, especially if you are hedge fund, you are investment bank, you are long-term investor. You want to know the cycle point, so you know this is the end of this cycle, what has happened here, what is likely to take place again, so you may be in tune with the market. Very, very important. In the video that we titled Wave Trading Education Part 8, I was telling traders the importance of the market itself, the wave count on the S&P 500, aligning it with the wave count on an individual financial instrument. In this part of the video, we want to align our wave count with the market cycle points. So I will show you one example now where a wave can become a bit challenging for traders. I'll bring on IBM, okay, a stock that is listed on the American Stock Exchange, this Dow 30, on the Dow 30, IBM, EPIC, IBM, okay, Indian Bravo Mike, okay. So we can see here, you see the vertical line, this is 2000, 2003, 2008, this is 2009. The 2009, we see this is another cycle point, which I did not talk about yet. The Federal Reserve around the world start printing money, especially United States. Mr. Bernanke was busy, okay, printing the dollar. But before that, in Japan also, they were printing a lot of money. The interest rate was very low, which means to borrow money was very cheap, and those who were saving money were losing money. So this is a major, okay, event, also a high impact event that also has an impact on the market. This is another cycle point. So year 2000, year 2003, year 2008, year 2009, we have a cycle point. In my humble view, I believe we will have another cycle point in 2016. I don't want to talk about it now, but I will just leave it here. And in fact, I will color it in yellow, my favorite color there, okay? All right, so what's happening now, ladies and gentlemen? As an Elliott wave trader, okay, you must know the cycle point. As I'm telling you now for IBM, you can see that you can see here, there's one very interesting example here. This is in 2008. You can see, pay attention. I want to zoom into it so you can see. We are here 2008. Pay attention carefully. You can see that in 2008, the S&P 500 start going down. All right. But you can see that the IBM, we are on a quarterly chart. All right. So each candle here is 3-month candle. So for 2 quarters, again, the IBM was going up while the market was going down. Now, when you see that, when you see a financial instrument that is trading against the market itself, but that was going in the opposite direction to the market itself, you want to check the fundamentals. Now, there are some stock that we call defensive stock. Usually, pharmaceutical stock are called defensive stock. So during a bearish season, okay, investment bank will invest in a defensive stock that can rise during bearish seasons. Very often these are pharmaceutical stock. They try to buy those stock. You will see that very often. I'll come back to that in another video when we will look at a specific pharmaceutical stock that can sometime trade against the market. But very often, if it's at a cycle point, most of the stock will comply or follow the market. All right. So you can see here, the IBM was going out for a while. If you see that, if you were here, the strategy that you will do, you will just draw, highlight the resistance level, the major resistance around that zone. That's what you will do. Because the market is going down, but a stock is trading against the market, you want to know where is the nearest resistance level. Because some stock did not reach the best resistance level. Remember, if the smart money want to sell, they want to sell at the best resistance level. So they know that they should sell, but they don't want to sell anyhow. They say, bring it here first at the best resistance level before we sell. So when we see a stock that is trading against the market, going up while the market is going down, we will highlight the resistance level and watch it. If we hit it, we will use our trading tool, to look for opportunity to sell it. But again, we must check the fundamental and be aware of the defensive stock that can trade, that can move in the opposite direction to the market. So you want to know what you are doing. All right. On the other hand, sometimes you will see the market will start going up, but a stock will continue to go down. All right, there is one example here. It's not very good one, but pay attention carefully here. You can see that from 2003, okay, to 2008, the S&P 500 was going up, but look, the IBM, there was a phase, okay, you can see the price went down during that period. Though the S&P 500 was going up during that time, the IBM went down for a while. Now, if we see that, we will highlight a key support level. See this candle here, the median line. Okay, that's why where the price did stop. Okay, or the see here. Okay. All right, we want to highlight the support level and monitor the price carefully there, because a stock is trading against the market, going down while the market is going up. We want to know which support level they are looking for. We do not just buy anyhow like old-fashioned way, but we want to make excellent decisions. Talking about the cycle point and the wave count, ladies and gentlemen, if you look carefully on this stock of IBM. For the S&P 500, it was very easy to count the wave, but because we see it went up, up to 2,000 somewhere here, and then we see, A, B, C. But for this stock, IBM, you can see that it went down, which in fact, this is a market leader. The IBM is a market leader. It's another matter we will discuss, talking about the trading triangle. You see that it went down in three waves, 1, 2, 3. From 2000 to 2003, all right? But while the S&P 500 started going up from 2003 to 2008, you can see that this stock, if you are counting the way, it may be a bit tricky. You may be wondering what's going on here, because you are wondering why the market is going up, it's pulling back. So you can get a bit confused, okay? You understand? You may get a bit confused because you may be wondering 1, 2, 3, and then in fact, what it did, if I want to count it like a little chart, we can highlight all the things that the price has done here, and you can see that it was not very clear. But by comparing the wave count of, or by using the market cycle, we can see clearly what is taking place here. Yes, the price was going up from here to here, but it was not in a straight move. You see, it went up, pulled back, went up, pulled back, and then before going up to this level. When we are counting a wave and we see the market cycle, we know that in 2003, there was a bullish cycle that has begun. Okay, this is a cycle point due to commodity super cycle. All right, we will expecting this stock to go up. Unless it's a dynamic bearish stock, which means the fundamentals are not sound, the dynamic bearish stock will go down continuously. Their true value also will go down at the same time, like the price itself. All right, those stocks, there's nothing we can do about it, because if they cannot cope with the competition, they are likely to go down more, though the market is going up. But if the general market sentiment is bullish, they are likely to profit from it, which means they will not go as fast as they should be. They will go down, but not as far as they should be. All right. So you can see here, we know that in 2003 there is a cycle point here. If I bring back again the S&P 500, using the market cycle to make a better wave count. All right, this is the S&P 500. All right, you can see here from 2003 to 2008, it was in a straight line, yes or no, all right? But it's not exactly the same thing we see, for the, IBM, all right? So there may be some, related fundamental reason to the IBM, why it did not go in straight line like this. You see, it was going straight up, the S&P 500. But if we bring back again the IBM, you can see that during that time, it was not doing exactly the same thing. So you may get a bit confused and see what's going on here, all right? So at this point, you can see this one went 1, 2, 3. A market leader went 1, 2, 3. We know that if there's a high after 3 moves, if the price change direction, that's the minimum price move, minimum wave count. If it start going up, we will take advantage of it a bit. So it went up a bit, betraying what is likely to take place if I start going up before the S&P 500. So this is a leading indicator here, because it went up 1, 2, 3. It's a corrective wave after this is a normal zigzag 1, 2, 3, and after an impulsive move 1, 2, 3, and it starts changing direction. You can see it start going up before the beginning of 2003, betraying what is likely to take place with the market itself, because this is a market indicator. a leading market indicator. So you see from this point, this quarter here, the IBM start going up already. It went on in 3 moves, telling us that, watch it guys, this market itself is likely, okay, to change direction, all right, at this point, because a new cycle is about to begin. But while the market was going down, the IBM start going up already, all right, before the market follow it. But somewhere in the middle here, though the market was going up, the S&P, the IBM also start going down instead, okay? So by using the market, aligning all your decisions with the market and the market cycle point, one can avoid making a lot of wrong decisions. When we see a cycle point like this and the market start changing direction, but we see a stock that continue to go down, we want to check the fundamental, highlight the first and nearest support level, because the smart money will always sell at the best, it will always buy at the best support level. On the other hand, when we see a cycle point and the market start going down, but a stock continue to go up, we will highlight the first and nearest resistance level, because the smart money want to sell at the best place. But it doesn't mean that we will definitely sell anyhow. Unless we receive a valid sell signal, we will not sell it. Okay? So you want to know, as an Elliott wave trader, what I've said today about 2000, 2003, 2008, 2009, you cannot afford to forget this. This is so important. When you are counting wave, you are paying attention to the market, but you are also paying attention to the market cycle point. The first market cycle point, the most recent, you need to know, in 2000, the tech bubble, 2003, commodity super cycle, 2008, real estate bubble or financial crisis, 2009, money printing that continue up to now. We are expecting, in my view, another, a market cycle point in 2016 that remain to be seen. Until the next time, enjoy yourself and be very happy. We are the TSTWSYS008 traders. Speak to you soon. This is about wave trading, part 10, using market cycle point to achieve a better wave analysis.